Today's video is an urgent warning to all investors, and I need you to pay extremely close attention because what's happening in the market right now is not normal. Whether you're a beginner, a long-term investor, or a trader who thinks you've seen every correction, this message is for you. My goal today is simple: to break down what's going on behind the scenes, the signals that are flashing red, and what you should prepare for next. I'm not here to create fear, I'm here to protect you from what many investors don't see until it's too late. So let's talk about why the next few weeks may become a defining moment for your portfolio. The first thing you need to understand is that the market is behaving in a completely different way than it did earlier this year. The trends that were supporting a stable rally are now weakening one by one. Major institutional players, banks, and hedge funds have started shifting their strategies, quietly rebalancing away from high-risk sectors and piling into safety assets. That alone should tell you something. Smart money isn't gambling right now, smart money is protecting capital. When you see liquidity dry up, volatility increase, and volume spike at unusual levels, those aren't random signals, they are early warnings. Over the past 2 weeks, we've watched unusual price action across several sectors. Tech, which has been leading the market for over a year, is showing cracks. Stocks that normally bounce fast after a dip are staying low. Momentum names are slowing. Even companies reporting strong earnings aren't seeing the usual strong breakouts. That means one thing: investor confidence is weakening, and when confidence weakens, selling pressure rises. Many investors don't realize this, but the market often sends warnings far before the actual drop happens. What looks like a small red day to you is actually a massive shift of millions of dollars. And when you add global uncertainty, interest rate pressure, and slowing business growth, the risk levels increase even faster. Right now, I'm seeing 3 major signals that every investor needs to understand. The first signal is the spike in fear-based trading volume. When volume is rising at the same time prices are falling, it means panic selling, not normal selling. That's the kind of pattern that appears before bigger market drops. The second signal is how defensive sectors like utilities, consumer staples, and bonds are suddenly moving higher. Institutions don't rotate into safe assets for no reason. They do it because they're preparing for risk. And the third signal is the weakness in small cap stocks. Small caps usually get crushed first because they're sensitive to market stress, and that's happening right now. The last time these 3 signals aligned, we saw a significant correction not long after. And while I'm not saying that a crash is guaranteed, I am telling you that conditions are lining up in a way that requires caution. This is not the moment to ignore warning signs. This is not the moment to blindly buy every dip. This is the moment to evaluate your strategy and understand the environment you're investing in. Now, let's talk about what investors are doing wrong right now, because this is important. Many people are buying riskier stocks thinking they're cheap, without realizing those stocks are dropping for a reason. Others are panic selling quality companies they should be holding. And then there's a group of investors who aren't doing anything, they're just watching, confused, hoping the market magically fixes itself. That's not how successful investing works. You need a plan, especially right now. So let's talk about what smart investors should be doing during times like this. Rule number 1. Protect your capital. Before you think about trying to catch a bottom or swing trade volatile tickers, make sure your long-term positions are secure. If you have profits from stocks that ran up this year, it might be a good time to trim. Not sell everything, just reduce your exposure. There's a difference between panic selling and risk management. Successful investors manage risk before the market forces them to. Rule number 2. Avoid high-debt companies and unprofitable businesses for now. When markets tighten, money flows out of speculative names first. Stocks with weak balance sheets drop the fastest. Look for companies with strong earnings, strong cash flow, and stable growth. Rule number 3. Build cash reserves. Cash gives you power. Cash gives you options. During uncertain markets, cash is not a wasted asset, cash is a strategic weapon. It allows you to buy discounted stocks when the market finally bottoms. Some of the greatest opportunities come during fear, but you can only take advantage of them if you have liquidity. Another thing I want to warn you about is the emotional mistakes investors make during these downturns. Fear is the enemy, but so is arrogance. Some people think they're unbeatable because they made money in last year's bull run. They forget that markets don't reward stubbornness, they reward discipline. If you believe a stock can't fall further, the market will prove you wrong. If you think you can time every reversal, the market will humble you. So instead of trying to predict the exact bottom, focus on positioning yourself safely. Let's talk about market psychology. When markets begin to fall, most investors react emotionally instead of logically. They sell at the bottom, buy too early, and repeat the same cycle every year. But here's the truth. Market cycles are normal. Corrections are healthy. Volatility creates opportunity. The investors who win in the long run are the ones who stay calm, follow their strategy, and don't let short-term noise take them off course. But right now, the market isn't giving us small warning signs, it's giving us loud alarms. And I want you to understand those alarms so you don't get blindsided. For example, insiders at major companies have started selling shares, not all, but enough to catch attention. That usually signals caution about the near-term outlook. At the same time, earnings estimates for next quarter are being revised downward. When analysts start cutting expectations, it means the economy isn't as strong as many believe. Another red flag is liquidity. When liquidity dries up, markets fall faster. And right now, liquidity is tightening across multiple sectors. This is not fear-mongering. These are real market indicators. Now let's talk about strategy moving forward. If the market continues weakening, we could see more volatility, more correction, and possibly broader sell-offs. But that's not a reason to panic, it's a reason to prepare. Look at your portfolio. Identify your strongest positions. Identify your riskiest positions. If you're holding stocks that have been underperforming for months, ask yourself, is this stock likely to recover, or am I holding it because I'm emotionally attached? You need brutal honesty with yourself during times like these. Also, avoid chasing news-driven spikes. In uncertain markets, many small stocks pump for a day and then crash. Don't fall for trap rallies. Instead, focus on long-term fundamentals. Ask yourself, does this company have real earnings, real growth, real demand, real assets? If the answer is no, avoid it. Another thing to keep in mind, don't fight the trend. If the market trend is down, respect it. There's an old saying, the trend is your friend until it ends. And right now, the short-term trend is weakening. That doesn't mean sell everything, it means stay alert. If the trend reverses, you'll have plenty of opportunities to buy. Let's talk about emotions one more time, because this is where investors fail the most. When markets fall, fear takes over. But the people who stay calm, strategic, and patient are the ones who win. The market doesn't reward fear or greed, it rewards discipline. So no matter what happens in the next few weeks, remember, stay level-headed. I also want to remind you that corrections are temporary. They feel scary in the moment, but when you zoom out, they are tiny bumps in a bigger long-term growth cycle. The biggest mistake most investors make is selling great stocks during fear and missing the long-term growth that follows. So if you hold strong companies, companies with real demand, real results, real growth, don't panic. Corrections are normal, but weaker companies, overhyped stocks, meme favorites, those can drop 30, 40, even 70% during downturns. That's why risk management matters. That's why you need to be selective. That's why I'm giving you this warning today. To all investors watching this right now, be cautious, stay prepared, and be strategic. Don't ignore the signs. Don't assume the market will fix itself overnight. But also don't fall into panic. Instead, follow a disciplined strategy. Protect your capital, trim risky positions, build cash, and prepare for upcoming opportunities. Because when this volatility ends, and it will end, the greatest buying opportunities of the year may appear. Until then, stay alert, stay informed, and stay disciplined. This is an urgent warning for your portfolio, and I want every one of you to be prepared.